Hello everyone and welcome to this new episode of Money Talk. The topic of today's video is going to be what is risk? We're going to see what is risk when you invest in stocks, what is the commonly accepted definition in academia, and also what very famous investors say about risk. Let's dive in. Before analyzing what the most brilliant brains in our society say about risk, let us see what are the formal definitions. We first have the definition of the dictionary Merriam-Webster, which says the possibility of loss or injury. We can also look at what Investopedia says about risk, and they say risk is defined in financial terms as the chance that an outcome or investment's actual gains will differ from an expected outcome or return. Risk includes the possibility of losing some or all of an original investment. What you have to remember is that risk is the possibility of losing money or getting a performance that is not as high as expected. To give a practical example, when I am assessing risk of a company such as Western Union, I am saying, what are the odds of the Western Union stock going down if I buy it now at $20? What are the odds of me losing money because the stock goes down? And believe me, risk is an enormous topic when you study or work in finance. I would even say that it is one of the biggest topics in the field. What represents risk and how to measure it. And back when I was studying finance, we all had to read this massive book about risk management. Just see how big it is, and it is full of formulas. But don't worry, in that video we will keep things easy and simple, because at the end of the day, risk is something much more simple than what we would believe. We will first see what the academia says about risk. We will see what colleges and business schools teach about risk. According to the academia, risk is something that can be quantified very easily with very simple statistical tools. I will show you now what are the premises of what we call MPT, also known as Modern Portfolio Theory. To use this theory, we have to first calculate the returns of a stock. I took the example of Western Union earlier, so let's keep that example. And imagine that the stock price of Western Union today is $10. And tomorrow it goes up to $12. The return of that stock is 12 minus 10. $2 divided by the previous price, so $10. It gives us a return of 20%. Now imagine I do this calculation again. I compute the return of the Western Union stock for every day in the last year. And then I compute the average return of Western Union for an entire year. And then I calculate what we call in statistical terms the standard deviation. I'm not going to bother you right now with any formula, but keep in mind that the standard deviation is the average deviation of all the data I have right there from the average. Graphically speaking, if I have a small standard deviation, I will have a very narrow chart. And on the other side of the spectrum, if I have a large standard deviation, I will have a very wide chart. And if you understood that, well, congratulations, because you now know how to calculate the risk of a stock according to the academia. As you see, it is pretty simple. If you watch the financial news or read the specialized newspaper, you will see that they talk a lot about volatility. And volatility is exactly that. The volatility is the standard deviation of returns of the overall market. So when we have a high volatility, it means that most stocks have a very high standard deviation. And when we talk about low volatility, it means that we have a low standard deviation of the overall stocks. I kept the theory simple, and there are more things about the MPT, but you got the main idea. That theory came out in the 1950s, and a couple of years later, another academic said, wait a minute, this is a little bit too simple. Risk can be quantified in a more precise way. And that is when KPM was born, or Capital Asset Pricing Model. Again, I will not bore you too much with the details, but this theory basically states that the riskiness of a stock can be defined and quantified by its beta. The beta is another statistical tool. that measures the sensitivity of a given stock with the overall market, with the benchmark, for example, the S&P 500. Let's take back the example of Western Union. And now I tell you that the Western Union stock has a beta of 2. That means that when the overall market goes up by 1%, or in other words, the S&P 500 goes up by 1%, well, the Western Union stock goes up by 2% because it has an elasticity, a beta of 2. And if the overall market goes down by 1%, the Western Union stock will go down by 2%. Of course, this is just an estimate of what will happen with the Western Union stock compared to the overall market. That does not mean it will happen always like that. But the KPM states that the riskiness of a stock can be measured by its beta. That means if a stock has a high beta, it is more risky than a stock that has a low beta. If Western Union, for example, has a beta of 2, whereas the Ford stock has a beta of only 1, that means that Western Union is more risky. So there you got the two big measures that the academia uses to measure the riskiness of a stock. That is the standard deviation and the beta. And you will hear about them very often in the financial news or the financial press. And a lot of professionals use these metrics very often. That was the theoretical part of the video. Now we will see what happens in practice. And specifically, what do two very famous investors think about those theories. What is the opinion of Warren Buffett about risk? I'm pretty sure you know who Warren Buffett is. He is one of the most famous investors on the planet and in history in general. Well, he says that all those theories I talked about before, that is the MPT and the KPM, are all garbage and that you should forget about them completely. I know that is very blunt, but that is his belief. He says that risk is too complex to be measured with simple statistical tools such as the standard deviation or the beta. He says that there are many factors that will make risk, that will contribute to the riskiness of a given stock. To take an exact quote of Warren Buffett, he says that risk happens when you don't know what you're doing. If we apply his logic, risk happens only when you overpay for a stock, when you pay a price that is too high for a stock. Because it doesn't matter if the stock has a very low standard deviation and a low beta. If you overpay for it, you will have risk. Because a stock that is overpriced has a big risk one day or another to go back and to go back to evaluations that are more normal. At the other end of the spectrum, if you pay a bargain price for a stock, it cannot be risky even if it has a high standard deviation and a high beta, because it doesn't have a lot of room to further go down. To summarize the thinking of Warren Buffett, if you always buy stocks that have a bargain price and avoid like the plague all the stocks that have a price that is too high, you will not have risk. To take a very recent example, if you bought stocks in December of 2019, it was much more risky than buying stocks in March of 2020 after the big coronavirus crash. Why? Well, because in December of 2019, everything, almost all stocks, had a very high price. So when things go very high in price, they will maybe go higher, a little bit higher, but one day or another, they will go down again. So it is very risky to buy things that are overpriced. And at the other end of the spectrum, if you bought them in March of 2020, they had a very low valuation. And when they have a very low valuation, they can maybe go down a little bit more, but at a moment or another, they will go up again. And that is exactly what happened. In April and May of 2020, there was a sharp increase in stock prices. To summarize, if you buy when it is low and you sell when it is high and you really apply this principle, you will avoid risk. But how can you measure? What are the metrics to decide whether a stock is overpriced or underpriced? Let us see that. The favorite metric of many investors to assess the expensiveness or the cheapness of a stock is the PE ratio, also known as the price-earning ratio. The calculation is very simple. It is the price of a given stock divided by the earnings per share of the company, and then you get the ratio. Imagine that the Western Union stock has a price of $10 and has an earning per share of $1. we get a price-earning ratio of 10. And the premise of investors such as Warren Buffett is to always buy stocks that have a low PE ratio. There are many other metrics of that kind, such as the PE ratio, to assess the relative cheapness or expensiveness of a stock. And I will put a link in the description if you want to learn more. And now we will talk about another very famous investor, David Drehmann. He's also the author of this book, Contrarian Investment Strategies. And he's considered to be a contrarian investor. That means he does exactly the opposite of what the crowd is doing. He's also a big critic of the academic theories about risk. So he's a very big critic of the MPT and the KPM. And he advises all the readers and the followers he has to just disregard those theories. His philosophy is pretty similar to Warren Buffett, and he says that you cannot have risk if you do not overpay for stocks. He likes the PE ratio very much, but more generally speaking, he says that you should avoid stocks that have unrealistic expectation. That is, those stocks that the general public and analysts expect to grow very sharply in the future, maybe 15 or 20%. That happens very often with stocks that had very good performance in the past. And people expect those performances to continue in the future or to even improve. But there is a reality. Things always go back to the average. So if a company had enormous growth during X amount of years, do not expect that to continue to be the case far off in the future, because more likely than not, it will go back to the average. You may also overpay for companies that did not have very good performances financially speaking, but have very good marketing and a very sexy value proposition. So people think that they will grow enormously in the future and that they will become the leader of their market. We saw a lot of things in this video about risk. We saw what the academia thinks about risk, we saw what Warren Buffett thinks about risk, and we saw what David Drehmann thinks about risk. Who is right at the end of the day? Well, I will let you be the judge. But personally, I also advise you to watch your PE ratio, be very wary of stocks that have a very high PE ratio, and also be very careful when you buy stocks that are in the hype very badly, like you know who. That's it for this video about risk. As always, I hope you enjoyed this video and learned something from it. Please hit the subscribe button down there to never miss a new video. And if there is a topic you want me to cover in a future video, please shoot me a message to the email address that is here in the description. I will see you very soon for the next video. In the meantime, take care.